So, when you think about stocks, what comes to mind? Probably just buying and selling shares of a company on an exchange, right? Simple. But what if I told you there's this whole other layer of equity instruments out there? Today, we're going to explore the special tools companies use to raise money and how smart investors can get in on the action in some pretty unique ways.
I mean, sure, you've probably heard of common and preferred stock, but trust me, there's a fascinating world just beneath that surface that a lot of people just completely miss. It's a world that can unlock special privileges, grant long-term opportunities, and even get you access to global companies you'd think were out of reach.
So in this explainer, we're breaking down 4 of these key instruments. We're talking stock rights, warrants, American depository receipts, and restricted securities. Getting these concepts straight is a total game changer, especially if you're gearing up for something like the SIE exam.
Okay, first up, let's dive into a classic pair that trips people up all the time. Rights versus warrants. They kind of sound the same, but you know what? Their purpose, their timeline, and who they're for, completely different. Nailing this distinction is absolutely fundamental. Okay, think of stock rights like this. They're basically a short-term exclusive coupon. A company hands them out to its current shareholders, and it's their way of saying, hey, thanks for being an owner, we're about to issue new shares, and we want to give you the first crack at buying them at a discount, so your piece of the pie doesn't get any smaller. But just like a coupon, they've got a really short expiration date. You got to use them or lose them.
Now, warrants, that's a whole other story. Think of a warrant as a long-term gift certificate. A company often bundles one with something like a bond to make the whole deal more attractive. It's a sweetener, right? It gives investors the option to buy stock at a fixed price, but with a much, much longer shelf life. We're talking several years, often.
And here is where it all clicks into place. Rights are a short-term tool for existing shareholders to keep their ownership percentage. Warrants are a long-term incentive to attract new investors. So at its core, one's a defensive move to protect the people already in the club, while the other is an offensive move to make a new deal more tempting.
All right, let's switch gears completely. Imagine you want to invest in some hot international company, maybe a huge tech firm in Asia or a luxury brand over in Europe. Sounds awesome, right? But then you start thinking about the logistics, and it can be a real nightmare. Thankfully, the financial world came up with a really elegant solution for this problem.
I mean, just think about the hurdles for a second. You'd be dealing with foreign stock exchanges, different currencies, a whole new set of rules and regulations. It can be a massive headache. So how in the world can you tap into all that global growth without all that friction?
Well, the answer is the American Depository Receipt, or ADR. Now this works is actually pretty genius. A major U.S. bank will go and buy a huge block of shares from a foreign company, they'll hold on to them overseas, and then they issue these certificates, the ADRs, which you can trade easily right here on U.S. exchanges. It's basically a passport for your investment money.
And this is the real magic of the ADR. You buy them, you sell them, and you get any dividends all in good old US dollars. It just seamlessly brings a foreign company into the US market, which makes investing globally almost as easy as buying a stock from a company down the street. But, and you absolutely have to remember this, ADRs do not eliminate the underlying risks. They're not a magic shield. The company is still operating in its home country, right? So you're still exposed to that country's political situation, its economy, and of course the risk that its currency could drop against the dollar. The ADR simplifies the transaction, but it doesn't remove the fundamental investment risk.
Okay, let's pivot one more time to the exclusive world of private placements. This is where companies sell shares directly to big, sophisticated investors completely outside of the public markets. But this creates a really interesting puzzle. How do you eventually sell those private shares to the public?
These are what we call restricted securities, and they're called that for a good reason. Because they weren't part of a public offering that was registered with the SEC, they come with strings attached. You can't just turn around and sell them on the NYSE the next day. They are, just like the name says, restricted.
So this is the million-dollar question, isn't it? If you're an early investor in a startup, or maybe you got stock as part of your compensation, how do you actually realize your gains? There has to be a legal way to sell these shares on the open market. And there is. It all comes down to one little number.
The answer is Rule 144. This one SEC regulation is the entire playbook for how to sell restricted securities. Seriously, if you ever hear the term restricted stock, your brain should immediately jump to Rule 144. They're linked at the hip.
Now look, you don't need to be a lawyer here, but you do need to get the big picture. Rule 144 creates what's called a safe harbor by laying out a crystal clear process. You have to hold the stock for a certain amount of time, you can only sell a limited amount at once, and you've got to follow specific filing rules. It's the official system for unlocking that private value and bringing it to the public market.
Whew, okay. We have covered a lot of ground, from shareholder rights to global investing all the way to private shares. So let's pull it all together into one final big picture summary. Think of this as your cheat sheet to lock in these concepts for good.
This table just lays it all out perfectly. Rights? They're a short-term tool to keep existing owners from getting diluted. Warrants? They're a long-term sweetener to attract new money. ADRs? A brilliant trick to make global investing simple. And restricted stock? Well, it has a clear path to the public market, and that path is called Rule 144. See, each one of these solves a very specific problem in the world of finance.
So there you have it, 4 special equity features that are working just below the surface of the everyday market. So I'll leave you with this to think about. Now that you understand these tools, from protecting ownership to investing across the globe with ease, which one of them most changes how you view the stock market and all the creative strategies companies use to grow? Thanks for joining me.